about what is accounting,
Hello everyone and welcome you all to UGC Net Preparation. So today we are covering Unit 2 of the Paper 2 Commerce, which includes accounting and auditing. So from this section we are covering accounting and its concept.
So I am Prapan Sharma, and I'll just be starting with the concept of accounting. So we all have heard in class 11, right, regarding what is accounting, accounts, and accountancy. So I will just briefly give you the meaning of the three statements or the three terms that I've recently said, that is accounting, accountancy, and account. So first we'll understand what is the meaning of account. So account is what we say is generally in the name of person, whatever we mention as in like Prapanch account or X account, Y account, etc. So these are all account we are talking about. And the next what I am saying is regarding accountancy. So accountancy is what it is. It is conceptual basis, and it includes all the principles, concept, and conventions that is followed while doing accounting. Fine. So now if we come to the term or the definition of accounting, which I'll be saying is, now accounting is the art of recording, classifying, and summarizing in a significant manner and in monetary terms the transactions and events which are at least of a financial character and interpreting the results thereof. So accounting includes the series of there are series of procedures or series of phases that takes place in accounting. So it is the art of recording. Recording what? We are talking about, for example, let's say I went to a shop. I just I bought a pen of rupees 10. So that has some impact on the whatever we are recording, whatever we are classifying, that has some impact on this thing. So that is all regarding your accounting. So it is analysis and interpretation of the bookkeeping records. So there are 10, 12 concepts of accounting, and we'll start with the very first one, that is business entity concept. Now, business entity concept deals that the business and the owners are two different or separate entities. That is, the managers and business are not the same. They are separate or they are different from each others. So as in shown in the diagram itself, the business and the managers, they are not the same, they are different. So the second concept deals with money measurement concept, which includes that the theory that the company should be recording only those transactions that are in terms of monetary transactions. That is, whatever is dealt with the money, or whatever transactions that happens in and out of the business with the help of money, are only recorded in the terms of accounting. For example, if I fight with someone in the company, that is not a part of that, no money is involved right over there, that is just a quarrel. So that is not a part of your money measurement concept. Only those items or those transactions being a part of financial character or affects the business comes in the money measurement concept.
The cost concept. So basically, the cost concept is the concept which states that the asset that are recorded in a business is always recorded at the amount that it was purchased. So the if we are purchasing any asset, as in we are purchasing a computer and we brought it at a certain amount, so we brought it at a certain price. So what are the costs involved in its transportation, in its installation and acquisition? So these are the amount, the cost. So this is the amount that will be generated as the cost of that particular asset. So that will be recorded in the books of account. So if it was brought in 20 to 10 at rupees 20,000, the computer will be estimated to be at the same price at 2017 in the books of accounts. Another one is the realization concept. So realization concept states that the revenue that is earned by a company, it is always recognized when it is earned. So the revenue, it will only be recognized when it is earned, as in there is a transaction that is done. So we all do this online shopping. So we are purchasing and the company is selling its product. So we are purchasing and we are making a payment. So after we make a payment, so there is a revenue earned. So a sales is done by the company. They are paying a certain sum of money. They are being paid a certain sum of money. So they are receiving it. So they are earning a revenue. So this is what is happening, that is a revenue is earned, so it will be transacted. So this is known as a realization concept. So another concept is relating to a dual aspect concept. So a dual aspect concept, it basically states that every action has an equal and an opposite reaction. That means that if you are making an entry, a debit is done, so a credit will also be done. So a situation of debit will lead to a situation of credit. So if there is a purchase of a product, so if we are purchasing a product is coming in, but we are paying them money, so money is going out. So when there is a debit, if something, there will be a credit. So if something is coming in, something will go out, and asset is purchased, money is going out. So that is the concept of dual aspect concept. Another one is the going concern concept. So going concern concept states that whenever an individual is running a business or started a business, they always foresee this future, that they will be running the business for a longer duration of time. They don't open a business just by claiming it to be open for 2 to 3 years. They always have a long-term motive stating that they are opening for a lifetime. So I will generally open a business stating that it will run for years and years and years later. As in, it shows out here until and unless I exist, the business will run, and even further that. So that is the concept of going concern concept. Another one is the accounting period concept. So generally, the transactions that are recorded in a business is segregated into different equal time periods, which is also referred to as the accounting periods. So the accounting period, it is recorded in terms of a calendar year or in terms of the fiscal year. So calendar year, that usually starts from 1st of January, and the fiscal year, which starts from 1st of April. The matching concept. The matching concept is basically the concept which states that the revenue must always be equal to that of the expenses that has been made. So it is considering that for any expenditure that we are making an equal revenue, as well as if we are making a revenue, that will also equal to the expenditure that we or the company is incurring. So these are the concepts that we will be discussing so far for today's session. And thank you for your patience. I hope you like the video, and please comment down about the videos and the topics that you would like me to cover. For and thank you, Prapanch, for your insight on the topic. Thank you, everyone, and see you on the next video.